what are we going to talk about today? We're going to talk about the internal adoption of AI within the companies that we cover. So if you're new to TBR, an important thing to understand about us is that our research focuses on companies themselves that are in the technology space. We look at their strategy, we look at their business model, we look at their performance. And once we understand that, then we stack them up against each other. So in that vein, when we talk about AI right now, when we talk about it today, we're going to be talking about the way that internal adoption of AI has changed these companies. And that's the second part of what we'll talk about, which is that change. What happens to the business models of IT services companies and professional services companies and consultancies as they adopt internally AI-enabled solutions. And then, of course, because we're TBR, we're going to talk about specific companies at the end of this. So I'm going to come back to that first point again and again as this goes on. But before we start, we wanted to take a little poll and ask everybody how you would describe your company's adoption of AI relative to your peers, or maybe to your 2023, 2024, 2025 expectations of where you would be right now. So we'll give you a minute to fill that out. And I will say this is exactly the framework that we are using with the companies that we're covering. That is, when we talk about, we'll come to this later in the deck, when we talk about business model disruption, we're looking at how much adoption of AI internally has changed the way these companies operate, and looking at it from a lens of either it's advanced adoption of AI, average, kind of same as everybody else, adopting AI and moving slowly, or of course, or the last part, moving slowly. So those are the options. And thank you for taking the poll. We'll come back to it in a minute. Let's just do a quick introduction. So I am Patrick Heffernan. I'm the principal analyst here at TBR that handles professional services and IT services. Our editing department did not like me including on this slide that I have to talk about everything, but I don't know anything, in contrast to Boz, who has to write about everything and does know stuff. But Boz, you want to introduce yourself?
Sure. Thanks everyone for joining us today. My name is Hristov, also principal analyst here in the professional services team. As you can see that my coverage on the slide spans 4 GSIs and consultancies, as well as leader research around ecosystem intelligence, digital transformation, as well as global delivery and automation.
Excellent. So polling results, I can't see them. Can you see them?
I do.
Okay. Can you tell me what they are?
37% advanced,
wow,
50% average, and adopting 12.5%.
And no one wanted to admit they're slow?
No. That's Honest Friday on Thursday.
Honest Friday on a Thursday. Yeah, that's pretty fantastic. 50% average. I guess we should expect that. The 37 advanced, or 38% really advanced. We'll come back to that later in the discussion. So we have developed what we call the AI Disruption Index. This, again, is looking at the companies that we cover and what has internal adoption of AI done to those companies. So why? Why did we take this particular approach? From the dawn of ChatGPT, for the first couple of years, there were so many questions about AI. And a lot of those questions, Boz, you remember, there was use case. What are the most heavily adopted use cases? There were also a lot of questions about investments. What does it mean when a company says they're investing $1 billion or $2 billion or $3 billion into AI? What kind of things were people using? What were the early success stories? What we found was a lot of frustration because there was no real clear way to measure what was happening within the companies with respect to AI. Were they actually changing? Were those investments, the $1 billion, $2 billion, $3 billion, actually changing the way that they were operating? Were they getting any return on that investment? So out of that frustration, we came up with looking at the impact, again, of AI on these companies themselves, and trying to understand what will change within the companies. How will their business models fundamentally change as they adopt AI? So that's the idea behind the AI Disruption Index itself. And then we're going to apply that to all of the companies that we cover within TBR, but we're doing it by peer set, which is really important to understand. And we'll come to this again when we point to specific companies, because the fundamental business model of the companies we cover, even in the professional services and IT services space, are very different. If you tried to compare the changes to a business model within Accenture to a company like, actually I was about to say DXC, that's a very bad example. A company like Infosys, you're actually talking about very different companies, especially then if you consider changes in the business model at McKinsey compared to an Accenture, compared to a HCL Tech. So what we want to do is keep it within the peer sets. You'll see those listed at the very end of the deck, the presentation. But that's the way that we're going into this. Our understanding of AI is looking very specifically at, again, the internal adoption of AI and what that does to the business model. That's very highly subjective. It's a qualitative way to look at change within the organizations of the companies we're looking at. Boz, at the same time, developed a very quantitative way to look at it, and that's what we call HIRI. Boz?
Sure. HIRI stands for Human Intensity Reduction Index. A scary name, fully recognize that. But it's exactly what it sounds like. We're trying to understand how the company's adopting AI, and not just AI, automation and analytics and the pricing levers and offshore leverage and utilization. I mean, all these pieces that are impacting how companies are performing. So this index essentially measures just, it's an encompassing of all these metrics blended in, and it's helping us to understand how fast the companies are moving along the kind of the spectrum of traditional labor arbitrage to more tech-enabled arbitrage, and in some cases trying to push the narrative of selling a little bit more of IP and trying to understand what it's going to look like and the impact their P&L is, the impact on their top line, on their bottom line. So what we have plotted here on the graph for the presentation today is the HIRI, or the Human Intensity Reduction Index, average for the first 8 vendors that we have profiled as part of our AI Disruption Index series reports. So those vendors will be discussed on the next slide, but it essentially is looking through that lens and understanding how those companies as a group are performing. And as you can see, from the dawn of ChatGPT back in 4Q22 through end of 2025, the green line that measures that index kind of like has ebbed and flowed, and it's back to where more or less where it was 3 years ago. And that's kind of an evolution of those company business models. Some of the companies are progressing a little bit faster than others. There's obviously some of those companies in the last 3 years have gone through some more restructuring. Some of them have gone through more acquisition strategies. So there's some kind of the weight of the various levers is impacting the individual company's performance. But we also try to understand, what does that mean for those companies moving forward, in the impact in the next 2 years, 3 years. So our model suggests that, a HIRI, that index hovering around the mid-20s, mid-20%, is where it's going to create really a favorable environment for those companies to start thinking about enact more as a tech-enabled arbitrage go-to-market strategies. And that's going to help them drive really a profitable revenue growth. Because as you can see, the other metric that we are plotting against to measure the HIRI progress is profitability, operating margin. It's a very standardized way of looking through all these companies, because everyone's measure their KPIs vary, and operating margin is consistent across all companies. So you can start thinking about free cash flow. You can talk about bookings. You can talk about like other metrics that you can measure that improvement. But our profitability is really kind of a way to think about how fast a company is transforming their business model. So as you can see, the profitability is kind of on upward swing as a group on average, with various degrees across the different vendors. But essentially is that, as I was starting a moment ago, a HIRI of mid-20s could certainly help those companies boost their profitability 5 to 7%. That's what our model suggests, which essentially is what those companies are aiming. Can we drive profitable revenue with fewer people, with less intensity by the humans, and maybe more machines? So it's going to become a combination of humans plus machines, or in some cases machines only.
And I think when it comes to some of the other peer groups that we're going to be looking at, and within the professional services space, that will include, and we've actually already published on, the hardware-centric vendors, so Lenovo, HPE, Dell Technologies, and Cisco Customer Experience as a peer set. We'll look at what we call the federally focused IT services companies. So that's that companies that serve primarily the U.S. government, U.S. federal government. And then we'll look at McKinsey, Bain, and BCG along with the Big Four as a peer set. and then we'll look at the India-centric companies as a peer set. And with all of them, as Boz said, 20% is sort of what we think is the target for where these are going. But that'll probably vary a bit for some of them. I don't think the big four are going to be that high. And I think perhaps the India-centrics might have to be a little bit higher.
Well, we'll see. We're getting some early indications that they may not be ready for that, but yes, potentially.
Right. Yeah. They may not be ready for it, but it might be coming, whether they like it or not. So
the
other half, so that's for the AI disruption index. That's the quantitative side of it, the HERE. And then on the qualitative side, we have this matrix, which, while I understand everyone always wants to be up and to the right, while I understand this is different than something we put out before, it's actually a lot like if you've ever seen TBR's bubble charts. It's similar in that way, although the bubble charts themselves entirely based on data. These are entirely based on our analysis of these companies, as we have been doing for, as a firm, 31 years, but every one of the analysts that looked at these companies has been looking at them for at least 10 years or more. And what we're trying to understand are what we started this discussion with, and our polling question around internal adoption of AI, and how much change is actually happening within these companies. How much have they truly adopted AI so that they're beginning to change their business model across the four areas that you see in the key code to the right there. So it's the operating model, the delivery model, the partner model, and the commercial model. So that part of it is, again, a very subjective view of the companies themselves and the way that they are adopting AI to change themselves. A lot of companies talk about client zero when they're selling that and saying, we've already taken this on ourselves. Here's our use case. We're looking at we've already taken it on ourselves part of it. And so that's sort of looking at the x-axis part. And again, it's not only what the companies are doing, of course, because we're saying advanced, average, adopting, and slow, it's also relative to their peers. The y-axis is perhaps even more subjective. Now we're looking at the go-to-market, the messaging around AI by these companies. And I think the best way to explain that is why is Fujitsu as high on that x-axis as they are. And that's because Fujitsu has had a very well-developed, mature AI messaging and AI go-to-market now for 4 years, perhaps ahead of a number of the peers that are on this particular chart. So that has kind of accelerated them to a higher position on the y-axis. And again, this is all highly subjective. We get that. We're actually going to be updating it probably quarterly. We update the financial data and our analysis of these companies every quarter anyway. So we're going to be including this in our assessment of these companies that we do every quarter going forward. So that's the business model matrix component of the AI disruption index. So to show you a little bit of what else is in this analysis. So we have released already 8 reports, company reports, the 8 companies that you saw on the last slide, and also a summary of all of those. And that's what you're seeing here, which is a slide from the research that summarizes these 8 companies, in particular looking in this case, the partner model. And you can see sort of the depth of the research that goes into this. We're looking at trends, examples, exceptions, and then what we think is coming forward. We did this across each one of the business models for these 8. As we do the other companies, we'll be doing the exact same thing. And then also wanted to show a specific company's HERE and what that looks like. And we're back to Fujitsu again. So Boz, I'll let you explain a little bit about Fujitsu and the HERE, and then I can explain a little bit about Fujitsu in terms of the overall AIDI.
Yeah, sure. So Fujitsu is a good example, as Patrick mentioned, for one of those companies that, looking at the company as a whole, has a very well-developed technology portfolio, including AI. I mean, we have heard about, Fujitsu's AI approach and AI strategy and AI messaging. And I think it was a couple of years ago, they were discussing the idea of like amalgamated AI. That was an interesting way to think about it. And I think fast forward, that has helped them to build up some awareness with both clients as well as technology partners. And as we look into Fujitsu again and developing the HERE, it's an improving trajectory, as you can see. Obviously, there's been some restructuring in the organization, which has helped. But I think there's a part of it that is the AI element that is really driving the business. We know that Fujitsu's America's business is really asset light, and it has helped them to push that narrative around with both Canadian and US clients. It is certainly a long way to go. I mean, we still see Fujitsu largely dependent on the Japanese kind of a first kind of an approach, but it's changing, it's evolving, and that's helping them to be a little bit more forward, set up with the clients here in North America as well as in EMEA. So that is helping as an organization. But again, they do have the AI native ecosystem. It's a big component of how Fujitsu is trying to perform and how Fujitsu is going to market. Additionally, the build out of their consulting business is also an element of success. The UVans, Fujitsu UVans that was launched a couple of years ago, and then specifically Fujitsu's Wayfinders, that's kind of the consulting sub-brand within UVans that's helping them trying to be a little bit more forward, kind of looking and stating and kind of departing from the traditional technology, centric, but still technology centric, but technology first sales and go-to-market motion essentially. So as we look into Fujitsu, I think the biggest element to see is like, can they depart from the seasonality of the operating margin? That's number one, because we know Fujitsu's business cycle is where 4Q comes, margin spikes, 1Q goes down, kind of like as you can see here on the graph. So there'll be an element and opportunity for Fujitsu to push that narrative around selling higher value services, but also selling AI first services as well, maybe AI technologies as well, and partnerships with the like of Palantir and others, I think, and AI natives certainly are in their favor.
Excellent. And so we're going to go to another poll question. I do want to say we are doing a hard stop at that bottom of the hour today, just because of our interest in making sure that we do this quickly so everybody can get the information and not belabor this because it's the summertime. So if you do have questions, send them in before we get to the bottom of the hour. So now on to a poll question. What has been the productivity savings in your organization? This is something that is sparked in part by something PwC said 3 years ago now, probably 3 years ago now, that they were able to save 30%, or they were able to see 30% productivity
as part of the pitch to the client.
As part of their pitch to their clients, which of course led to, well, then take 30% off of our fees, please, or our bill. But so while you're doing that, I will say we have our clients who have already seen this research have come back with questions, and I would say the way that they're using it. I'll let you speak to Hiri. I know. Well, one thing quick on Hiri, I think it is another tool, another way, another metric of measuring an organization and where they're headed. Yeah. So a lot of our analysis is taking data that's publicly available, using our own taxonomy and our own modeling to create estimates and understand where a company is headed. That's very heavily data-based, very analytical. Hiri plays into that. Boz, are there other questions you're getting specifically about Hiri and like how to use it, how to think about how to use it?
Yeah, so I think that's exactly right. How to use it. And one area that we have had lengthy discussion has been around utilization and the productivity as a productivity proxy, essentially, right? So as I mentioned in the beginning, it's a blend of several metrics and several KPIs that are fed into that index, essentially. So it's not an AI pure index to say all these profits or all these adjustments of their operating models as a result of AI solely. That's not the case, but it's an indicative, it's a directional productivity proxy that allows companies to think a little bit more about what's next in their hiring strategy, their resource management strategy, what's next in their portfolio strategy, and I think increasingly more importantly, what's next in their commercial model strategy, because that's a key element of like getting paid, going to market, but also partnering as well, because we're seeing that as a big gap between services and technology partners around the commercials, and here is giving them a little bit of a sense of like, what is that going to look like for the ecosystem? Because traditionally those companies have made a bet and have made a living out of the bigger the scale of my technology partner program is, the better it is, and still the case is, but it's kind of shifting the narrative from not just a scale with all partners. It's more about deeper bench with select few partners, and that's a change where Hiri is providing that guidance for some of our clients.
Yeah, and I think to that point on partner and commercial models, I mean, that's exactly what our clients are looking at, the business model disruption matrix part of it, and saying, okay, how do we better understand where there's flexibility from the partner side and where there's flexibility from the commercial side. So this last slide I wanted to show is just sort of a summary of what's in that deck that includes all 8 of the companies that we've done this to so far. And I can't stress, point number 3 here enough. This is sort of a roadmap to where we think IT services and professional services is heading right now. And that last question is really, or that last point is really what's driving a lot of the questions we're getting from clients. And of course, the winning formula, as we've said for a long time, is let AI be a catalyst of change within your organization, not just trying to go out and sell it. So with that, let's see what the polling results were. 57% is 0 to 10%. That is wow. 28%, and then 14. Nobody at PwC is 30 plus, but those are pretty good. Those are pretty good results, actually. Boz, any thoughts on those?
Yeah, I think that kind of falls into what we have heard from conversations with clients, as well as kind of the enterprise buyers overall, where the benchmarking is hovering between 15 to 20%, kind of like as a kind of broad stroke. Numbers that we have heard across varies across different industries, across different lines of business as well. But I think it's an important, it's an honest view. I think it's a sober view and reality of like, what does that mean next? Where do those savings go? Do they go back in the organization for reinvestment in R&D? Do they go into the clients so they can help them to win a new deal? And these are some of the big questions, or the kind of most of the services companies are trying to answer for themselves, especially as they're trying to calibrate the staffing pyramids and they're trying to adjust their portfolio. Because as we know, the P&L for a services company looks a certain way, and the P&L for a software company looks completely different. I mean, the structure is completely different. Gross margins levels are different. SG&A is different. So developing that hybrid model with enabled by some of those savings, I think it's a kind of it's a strong indication. It's a good indication for us to think about, and it's a confirmation of where the market is heading. Obviously, the buyers are the final judges. That's going to make the final call what it all means for them. But it's good. It's kind of falls into the benchmark we hear as well.
Excellent, thanks. So just to wrap up, I know we've got a couple of questions in the queue, and we'll get to them in just a moment. But I just wanted to share, and everyone who's on this, as Haley mentioned at the beginning, will get a copy of this deck. I just wanted to share that there is an explanation in here around the AI Disruption Index, what the different components are, our definitions on those different components, much like you'd see a taxonomy slide within a standard technology business research report. Now we also have here the different kinds of reports that we do, if you're not familiar with us. And then I also included the whole long list of all the different companies we cover and all the different areas that we're covering. So it's just not just the professional services practice. We also have cloud and software, telecoms, infrastructure, devices. Is there anybody else? Am I forgetting anybody? I don't think I'm forgetting anybody. And so with that, we will go to questions. And the first question that we have, not surprisingly, seems like this comes up all the time, is, let me read it out here. What does Accenture's HIRI look like? Boz, that is 100% for you.
Sure. So, I mean, Accenture obviously is like, 800,000 people organization. Yeah. So achieving that HIRI of 20% that I mentioned earlier, it's going to take some time. But we have, developed the model. It's part of the first 8 group. So if I recall the numbers, back in 4Q22, when we started measuring the HIRI development, they were in about -5%. In the last, couple of quarters, they are close to +5%. So that swing of, 10%, so 1,000 basis points across over 3 years, it's a really positive signal for a large organization as Accenture is. Obviously, it's going to take time it's going to be more important sustaining that HIRI, because we see Accenture making huge bets on acquisition specifically that's going to supposedly help them to drive non-FTE based revenue, while they still talk about hiring freshers. So there's that mix of utilization of freshers that are AI native, meaning AI graduates, and then the onboarding time is much faster, and so they can become billable employees with acquiring assets that they can help them drive some non-FTE revenue. Those are the key elements. I always said Accenture is an aircraft carrier, so making the turn 180 takes some time. but the theory suggests that they're in the right trajectory. I know that the shareholders on Wall Street may have not been happy and may disagree with me in the last quarter or two, but I think the stickiness that our organization has across enterprise buyers as well as the ecosystem, I think still makes it quite relevant.
And if Accenture is an aircraft carrier, knowing that a carrier doesn't deploy on its own, but always in a carrier battle group, you got to kind of know where the aircraft carrier is going if you're going to be part of the aircraft carrier group. So that's another advantage to this research. The last question, then we'll have to wrap. The question is, will HIRI apply to other technology companies that TBR covers? I think that means companies like, I know we have Supermicro just went out the other day. The list is right there. So we have Dell beyond just the services, Lenovo beyond just services, HPE.
Yep.
So for a lot of, the answer is yes, but yes, we will have a metric similar to HIRI across every company that we cover. It won't be human intensity reduction index for everyone, because companies that are not services companies don't have a large services component, don't have the same human intensity as part of their business model. And the sort of promise of adopting AI within those companies is not about reducing the human effort that goes into generating increasingly marginally better revenue. So it doesn't quite apply. So like a Supermicro, I'll be honest, I don't even know what Supermicro does, but there's our infrastructure team has come up with a different way of getting to the same quantifiable understanding of what AI adoption has done internally to that company's business model and their financial performance. So that actually, I guess I would say, just go find the Supermicro report from TBR that I swear came out this week, and you can understand how, as a firm, we're sort of all in on understanding how AI is changing the companies that we cover and finding ways to apply our own metrics to that can be used in a way to compare across peer sets. Again, keeping it very tightly aligned to peer sets so that we're looking at the different business models. So